Venture capital funds target annualized returns of 25 to 100%, knowing full well that most companies they back will eventually collapse. Venture capitalists prioritize businesses capable of capturing an immediate market. Nifty products or revolutionary ideas that might take 20 years to gain public acceptance rarely survive the initial filter. Ask any seasoned investor what makes a deal successful, and you get the exact same 3 words: management, management, management. Investors demand verifiable, current historical data. Relying on optimistic projections or expecting a hired accountant to handle the numbers is a fast way to kill a deal before it begins. An idea, no matter how clever, cannot generate a return on its own. Without a strong founder who lives by the numbers and operates in reality, the financial risk is simply too high. To see if a founder has what it takes, investors put them through a psychological gauntlet. They test for absolute honesty and a massive reservoir of energy to survive 70-hour work weeks and a proven track record of achievement in their specific industry. They bypass the curated list of references provided on the resume. A thorough due diligence process means speaking directly with the founder's former customers, their suppliers, and their bankers, alongside pulling deep background and credit reports. The goal is to build a partnership resembling a marriage. Both sides must trust each other, and both sides must be driven by the exact same goal: building a highly profitable business. Early-stage business is highly volatile. By exhaustively verifying the character and competence of the management team, investors neutralize the largest variable in the equation: human error. Once a founder survives the vetting process, the verbal handshake is replaced by the legal closing. This is anchored by the term sheet, the document that dictates exactly how the investment will function. The term sheet governs exchanging capital for structured equity, guaranteeing their exact slice of the pie. But equity isn't enough. The investor also builds a structural safety net, locking in mandatory seats on the board of directors. They also write in strict legal covenants that restrict how the cash can be spent. The founder cannot issue dividends, sell off major assets, or buy a corporate airplane without the investor's explicit approval. And if things go wrong, there is a final failsafe. Using a mechanism called a voting trust, the investor can legally seize operational control of the founder's shares and replace the management team entirely if critical revenue milestones are missed. The term sheet functions as a legally binding blueprint. It is engineered to eliminate downside risk and force financial discipline through contractual obligation. There is no such thing as a passive venture capitalist. Once the legal documents are signed and the check clears, the monitoring phase begins. Looking at a tracking file like this one, you can see how obsessively investors monitor the health of their portfolio. They demand certified monthly financial statements, analyze daily cash burn rates, and constantly compare the startup's original projections against its actual reality. This vigilance is necessary to spot the early warning signs of a crisis. If profits suddenly drop, or if there is an unexplained buildup of physical inventory, the investor knows the company is burning through its runway. The investor doesn't step in to run the day-to-day operations. Instead, they use their board authority to force a strategic pivot, halting the bleeding and stabilizing the cash flow before the bank accounts hit zero. The outsized returns that venture capitalists make are earned right here in the trenches. They use their control rights to course-correct a failing startup before it runs out of money. Even a wildly successful scaled-up company faces a ticking clock. Venture capital funds have finite lifespans, usually between 5 and 10 years, which means the investors eventually have to return the principal to their own partners. This brings us to the ultimate objective of every single deal, the liquidity event. This is the moment when paper equity is finally traded for cash. There are 3 primary ways out. The first path, shown here, is an initial public offering, where the startup registers shares and sells them to the public markets, creating an avenue for the investor to cash out. The second exit is an acquisition. In this scenario, a larger strategic buyer in the same industry swallows the startup whole, paying off its debts and sending a lump sum payout directly to the existing stockholders. The third route is a recapitalization. Here, the startup uses its own robust cash flow, or takes on new bank debt, to buy the venture capitalist's shares back directly. Being wealthy on a balance sheet means nothing in this business. An investment is only viable if there is a concrete mechanism to cash out planned from day one. From the aggressive vetting of the human element during the pitch, to locking in strict legal protections, surviving the operational trenches, and finally triggering the exit. Venture capital is a rigorously engineered, step-by-step system. It replaces the uncertainty of gambling with a methodology designed to force a successful outcome.